On Friday, the market was preparing for a sharp sell-off. New tariffs were being discussed, headlines were turning cautious again, and the market started to price in something that nobody really wanted to see: the return of trade tensions. Because tariffs are never just political noise, they are economic friction. They increase costs, they create uncertainty, and they complicate global supply chains that, after months of disruption, are only now starting to stabilize. But then something shifted. The tariffs proposed by Donald Trump in April 2025 were rejected by the Supreme Court. And almost immediately, the tone changed. Futures stabilized, volatility eased, risk sentiment improved. So the question now becomes, did the market just dodge a trade war? And more importantly, what does this actually mean for investors going into 2026? Because relief headlines are easy to celebrate, understanding their structural impact is harder. That's what we're going to break down. But first, welcome back to Rebuild Finance. This channel is about documenting a long-term investing journey, building a portfolio over time, and sharing the thinking behind each decision. My goal is simple: find elite businesses, buy them at fair prices, and hold them for the long run. If you enjoy this type of analysis, subscribe to the channel. In April 2025, markets reacted sharply to what Donald Trump called the Liberation Day tariffs. The announcement came suddenly. The language was aggressive. Investors immediately began pricing in the possibility of a renewed trade conflict. Futures dropped, volatility picked up. Analysts started revising their inflation and earnings models to account for higher import costs. But the concern was not simply about a 10% tariff. The concern was escalation. Markets were asking whether this was the beginning of a broader cycle, one that could disrupt supply chains, compress corporate margins, and complicate the path of monetary policy at a time when inflation expectations were already sensitive. Tariffs, after all, are economically equivalent to taxes on imported goods. When input costs rise, companies must absorb the impact somewhere. They can accept lower margins. They can pass costs to consumers and risk weaker demand. Or they can attempt operational adjustments that rarely happen quickly. None of these outcomes are neutral for earnings, and markets price earnings. As a result of this unexpected announcement, the S&P 500 plunged at the beginning of April 2025, losing more than 10% in less than a week. That move was not about a single tariff percentage. It was about the fear of a broader escalation cycle. What has changed between April and today is not the existence of tariff rhetoric. What has changed is how the market processes it. After the initial announcement, some measures were delayed or rejected. Negotiations entered the discussion. Analysts had time to model sector exposure more precisely. Investors observed that the path from announcement to full implementation was neither immediate nor guaranteed. The shock faded. What initially felt like an abrupt escalation began to resemble a recurring negotiation strategy. In April, tariffs were a surprise. Today, they are part of the scenario investors already expect from Donald Trump. That distinction is crucial. Markets react aggressively to unexpected information because it forces a rapid repricing of probabilities. Once a risk is incorporated into forecasts and valuation models, the same headline carries less emotional weight. Investors begin distinguishing between rhetoric and execution. Now we need to examine the practical side. Trump is clearly frustrated by the Supreme Court decision. So the question becomes, if he wants to escalate, what practical tools does he still have available? Even without new legislation, the executive branch still holds significant authority over trade policy. Sector-specific tariffs can be imposed under national security or unfair trade provisions. These measures could target autos, semiconductors, steel, or battery supply chains, creating pressure without immediately affecting the entire trade system. Export controls could also be expanded, particularly in advanced technologies such as artificial intelligence hardware or high performance chips. This would increase geopolitical tension and could directly impact specific segments of the technology sector. There are also options involving tighter scrutiny of foreign investments or restrictions on outbound capital flows. Each of these actions carries different implications. Broad immediate tariffs would raise systemic uncertainty. Targeted measures would generate volatility concentrated in specific industries. Rhetoric alone would likely produce short-lived market reactions. And at the moment, markets appear to be interpreting the latest announcements, including potential increases from 10% to 15%, as part of a negotiation framework rather than the start of an uncontrollable escalation cycle. This brings us to the most important point. Why is the market not reacting the way it did in April? Because investors have learned the pattern. Announcements are made with strong language. Markets initially react. Negotiations follow. Measures are adjusted or partially implemented. The final outcome often proves less extreme than the initial headline suggested. When patterns become recognizable, emotional responses diminish. We are likely in a phase of desensitization. This does not mean that trade policy is irrelevant. It means that the risk is now modeled. Investors are discounting the probability that current announcements will evolve into a full-scale trade war with rapid retaliation and broad implementation. As long as tariff increases remain gradual, targeted, and open to negotiation, they are perceived as manageable. There is also a macro backdrop that supports this calmer reaction. Inflation is not accelerating sharply at the moment. Corporate earnings, while not spectacular, remain relatively stable. Financial conditions are not tightening aggressively. In a fragile macro environment, similar headlines could trigger stronger volatility. In a relatively stable one, investors have more tolerance for political noise. However, desensitization can be rational or dangerous. It is rational when it reflects improved probability assessment. It becomes dangerous when markets assume that escalation will always follow the same diluted path. The real risk lies in a break of the pattern. If tariff threats were followed by immediate, broad implementation and rapid retaliation from trading partners, repricing would be swift. Markets can adapt to predictable tension. They struggle with sudden structural shifts. That's a line investors need to watch. So the final question is simple. What does all of this mean for investors heading into 2026? Looking ahead, equity performance in 2026 will likely depend more on earnings, growth, capital expenditure cycles related to artificial intelligence, and the trajectory of monetary policy than on isolated trade headlines. Trade policy remains an important variable, but it is one component within a broader macro system. Avoiding aggressive escalation reduces tail risk. It does not create growth by itself. So when we ask why markets are not overreacting to new tariff announcements, the answer is not that investors have become careless. The answer is that they have adjusted their probability distributions. Tariffs are no longer an unexpected shock. They are a known variable. For now, markets are responding to implementation risk rather than rhetorical intensity. As long as execution remains gradual and negotiable, volatility is likely to remain contained. If that execution becomes immediate and systemic, the reaction function will change quickly. Until then, we remain in a phase where political tension is persistent but manageable. And in financial markets, manageable risk is very different from unknown risk. The real risk is not the headline. The real risk is a break in the pattern. And that is what investors should truly be watching. If you want to follow this journey to financial freedom and see exactly what I'm buying and why, make sure to subscribe. And if you are curious about what is happening and why the major software companies are selling off, make sure to watch this video right here. Thanks for watching, and I will see you in the next one.